I told you that all of Indonesia's economic policy problem can be fixed with one simple change? So here's the problem. In a single month in 2026, Indonesia watched $80 billion of market value evaporate. That's a lot more than SpaceX raised for their IPO. And the rupiah hits its weakest financial point since the Asian financial crisis, breaking its own all-time records. Energy inflation spiked to 67%, and the entire sequence was not an accident. It was a menu choice, the result of the long-standing economic policy. Let's put political issue and corruption aside for a moment and discuss the theoretical economic base of operation as applied in Indonesia. And to make it quick, let me give you the cheat sheet up front. There's this thing in international economics called the impossible trinity. Picture a triangle. At each corner sits one of three policy goals a country can choose from. Corner one is the independent monetary policy. That's the ability to set your own interest rates for your own factories, for your own inflation, without a foreign central bank forcing your hand. The second corner is the free capital movement. Money flows in and out with no barriers. Investors do what they want. Corner 3 is the fixed exchange rate. You nail your currency to another currency and keep it perfectly stable. Now here's the rule. Stripped of the jargon, the impossible trinity just says that a country can only pick two of these three things and never all three. Pick two, that's it. And the catch is that the one you leave on the table doesn't just sit there politely. It becomes your pressure release valve, moving on its own whether you're comfortable with it or not. If you pick the stable exchange rate and open capital flows, money races across borders chasing tiny yield differences, and your central bank has to copy whatever interest rate the anchor country sets. You have lost control on your own thermostat because of this. If you pick independent rates and open flows, your currency bounces with every global mood swing. And if you pick independent rates and stable currency, you have to physically stop money from stampeding in and out. That's the whole menu. Three combinations, and every single one hands the unselected option over to the market or to gravity. Most countries pick the first combination I mentioned, independent rates and open flows, and let their currency bounce around. The United States does it, the UK does it, and so does Indonesia. And that setup works just fine until the moment it doesn't. And you watch $80 billion turn into an exit sign. I've spent the last few weeks reading central bank reports and market data from a country that lost $80 billion in a single month, and I can tell you this. Nobody was surprised. Not the fund managers who pulled the money, not the policymakers who watched the rupiah slide past 17,000 to the dollar. Nobody even pretended that this was a black swan event, because it wasn't. This was a feature of the economic system. The 2026 timeline reads like a script someone wrote in 1997 and just changed the dates. Early in the year, the MSCI index people float a warning. Maybe we'll downgrade Indonesia's emerging market status. It's a little governance control. Nothing for the real economy would feel on a Tuesday. But here's why that whisper functions like a starting pistol. When MSCI downgrades a country, every passive index fund on earth that tracks that benchmark is now mandated to sell. They don't choose to, their algorithms force them to. So a governance footnote becomes an automatic sell order worth billions, all executed in the same week. And in a setup where capital is free to move, that sell order triggers a stampede. Foreign fund managers start dumping Indonesian stocks and bonds, and every time they sell, they convert the rupiah proceeds back into the dollars. With more sellers than buyers, the rupiah has nowhere to go but down. The Jakarta Composite Index collapses, the currency slides, and because capital is free to move, none of it can be slowed down. Not a speed bump, not a mandatory holding period. The door is open and everyone walks out at once. But I need you to picture the central bank's balance sheet underneath all of this. There's a pile of foreign reserves. There's a domestic interest rate set at 4.75%. And there's an open channel to global bond markets. When the US dollar strengthens, and it was strengthening because the Middle East was on fire and everyone was running to safety, the math becomes inescapable. Money wants to be in dollars, earning higher, safe returns, not in rupiah assets with political risk attached. So the central bank has exactly two moves, both of them painful. The first one is they burn reserves to buy rupiah and prop up the currency, or hike interest rates to make holding rupiah worth it. And they did both. The inflation followed. Energy went up 67% year over year. Headline inflation nearing 5%. That wasn't an external curse. That was the weaker rupiah passing straight through to every liter of imported fuel. Indonesia imports most of its fuel, and fuel is priced in dollars. So weaker rupiah means more rupiah for the same barrel. That price jump lands directly on pump prices, transport costs, electricity, which meant that a factory owner in East Java got hit from two directions at once. Her input costs, that is fuel, shipping, raw materials, all spiked because of the weaker rupiah. And her ability to borrow working capital to cover those costs, that got crushed too because the central bank just hiked rates to defend the currency. She couldn't price her production costs within 30% margin. She couldn't get a loan to bridge that gap. And she wasn't even doing any of the speculating. She was just open for business in the wrong monetary regime. Now here's the part where the policy response gets genuinely strange. Faced with this capital flight, the Indonesian government did something that sounded tough. They forced commodity exporters to keep their dollar earnings onshore in local banks for a set period. Seems familiar? That's one corner of the impossible triangle, and that is capital control. That's an admission that free movements was killing them. And then, in the same exact month, they accelerated stock exchange transparency reforms specifically to lure back the same hot money that just fled. It's like locking your front door and then putting a neon sign in the window that says, "Please come back, we fixed the lock." The capital control tries to trap dollars onshore. The transparency reforms tries to attract new inflows. They pull in opposite directions, and the structural vulnerability sits there untouched. What's actually happening here is the government is trying to sit on all three corners of the Trinity at once. Manage the exchange rate, keep capital flows open enough, and still sets its own rates. But remember the rule. You cannot pick all three, only two. Try to grab the third and you don't get the best of everything. You get a policy that ricochet between contradictions, satisfying nobody. So you end up with a halfway policy. Tough enough to look serious on the front page, soft enough to keep the bond market open for business, and it's a crisis management designed by the people who profit from the crisis. The 2026 Indonesian economic crisis wasn't a proof that capital controls are too risky to implement during calm. It was a proof that not having them during calm is what guarantees the crisis. Every global downturn, which means the Fed tightening that will happen eventually, the next commodity price collapse, whatever conflict flips the risk off switch and sends global investors running for safety, will trigger this identical chain every time. Free exit caused the capital flight, rupiah plummeted, imported inflation spiked, the central bank was forced to hike rates, and the government budget got blown out because when you have to pay 7.5% to borrow instead of 5%, the interest bill eats the budget alive. Money meant for roads and schools gets redirected to bondholders. Every crisis like this permanently lowers the growth trend. The 8% GDP target becomes mathematically harder to reach because the capital that would have built the next year's factory just left the country. The only structural escape is to move toward the other combination. Independent rates, a managed stable exchange rate, and capital controls. Deliberately, gradually, starting now before the next shock makes the decision for you in a panic. So the obvious answer is staring straight at us. Indonesia needs independent interest rates and a stable managed exchange rate, which means it has to let go of open capital flows and implement capital controls. let me be clear. This is not a wall, but instead, this is a two-tier filter. Here's what that actually looks like. Tier 1 is when long-term factory investments such as trade finance is greenlit, smooth entries, and guaranteed exit for taking your profits back to your home country after 5 years. Exporters and manufacturers get something else too, a managed band. This means the central bank announces a floor and ceiling for the rupiah. Say for example 14,500 to 15,500 to the dollar, and commits to defending those boundaries. That means a factory owner knows the worst case exchange rate a year from now. She can price her products, she can plan her company's future roadmap to prosperity. Tier 2 is the short-term bond punts, carry traders, who borrow cheap dollars, convert to rupiah, buy Indonesian bonds to pocket the yield difference, and break the lease the moment the Fed blinks. Those flows get slowed down, taxed, or blocked entirely. That's the actual shape of the third combination. Not a cage for investment, but a filter that keeps the destructive flows out while letting the productive ones through. And every country that built an industrial base from scratch used some version of this filter. It's not even a radical idea. It's just not what your global bond market wants you to believe is allowed for a country like Indonesia. And the typical objection is that the foreign direct investment will flee if you restrict capital. Is almost touching in its innocence after the data. The crisis you just analyzed did not restrict capital. It was an open account free-for-all, and yet foreign direct investment stalled. Long-term factory builders didn't say, oh good, free flows, let's invest. They saw a currency that could move 20% in a month, energy inflation at 67% variance, and a central bank forced to hike rates until domestic credit choked. That environment is a welcome mat for carry traders. And here's what carry traders do. They borrow money in a country with dirt cheap interest rates like Japan, the US, wherever, and convert it into rupiah and buy Indonesian government bonds because the yield is higher. And then they pocket the difference. That's the whole business model. They're not building anything, they're not hiring anyone, they are just renting Indonesia's currency for the interest spread. And when the Fed blinks or a global panic hits, they dump the rupiah, convert back, and vanish. That stampede is exactly what crashed the Jakarta Composite Index in a single month. It's what forced the central bank to burn reserves and then hike rates into a crisis, which choked domestic credit and blew out the government's borrowing costs. The carry traders got their profit window and left, while the factory owner in East Java got the invoice. These carry traders are who the open capital account actually serves. But for the actual foreign investor who wants to build a factory, sign a 10-year contract, and hire workers, an environment where the currency swings 20% in a month, energy costs spike 67%, and the central bank is forced to hike rates until domestic credit freezes up. Now that is a minefield for them. Investors who build smelters and battery plants need a predictable exchange rate and a government that isn't hostage to the next MSCI rumor. The other combination of the impossible Trinity that implements independent interest rates, a managed stable exchange rate, and capital controls gives them exactly that. First, by implementing a managed band, which means the central bank sets a floor and ceiling for the rupiah and commits to defending those boundaries, so a factory owner knows their best and worst case foreign exchange rate a year from now, then a two-tier system blocks the kind of money that extracts profit, then just fled. The carry trade, the short-term bond punts that crash the rupiah and force their rate hikes. These people are blocked off, but guarantees that you can take your promise home on a predictable schedule. That's what every industrializing nation from South Korea and China actually used. I mean, China was much, much poorer than Indonesia at the time when it locked the door and built its industrial base behind it. The system works. So, the 2026 Indonesian economic crisis was not a shock. It was a structural exhale, the inevitable outcome of a system where money moves freely across the border in a country that depends on commodity exports during a moment when global investors are scared and pulling capital from everywhere. And the response was not a recovery. It was a series of contradictory moves that admitted the open flow setup is broken while still trying to seduce it back to life. So I kept thinking about that factory owner in this Java. She did not need free capital flows. She needed a stable rupiah and an interest rate that she could borrow against. She's got the opposite, and the system calls it necessary. The crisis previews every future downturn until the structural vulnerability is removed. And the vulnerability is not a fact of nature. That was a policy choice, one that can be unmade simply by picking the correct side of the impossible Trinity. Subscribe!